Do you dread the thought of paying huge capital gains taxes? Are you hesitant to rely on a 1031 exchange, which can seem time consuming? Or maybe you don't qualify for a 1031 and are running out of time to purchase a property. So relax. We got you covered today. In today's show, we will introduce an alternative solution to defer 100% of your capital gains taxes. Our guest speaker will help you navigate the complexities of tax deferral so you can enjoy huge savings on your investments. No more sleepless nights worrying about paying too much taxes. Stay tuned and take the first step towards a secure financial future. Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everybody, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes, and aside from hosting this monthly show, I am first and foremost a real estate entrepreneur and personally invest and assist others to invest in real estate. You can find out more about me at ismaelreyes.com. In this group, we learn from and help each other create generational wealth by investing in multifamily. We concentrate on Greater Central Florida assets or potential investment partners. All right. And speaking of our guest speaker, I'd like to welcome Brett Swarts to the show. Brett, what's going on, man?
Hey, Ray, it's great to be here. I'm excited, grateful for the opportunity to share some knowledge and to geek out about some capital gains tax with everybody.
So while you're kind of looking at that, let me go ahead and do your formal introduction, Brett.
Sure. Sounds good.
So Brett is an entrepreneur, CRE, commercial real estate investor, podcaster, deferred sales trust educator / trustee, and North Carolina multifamily broker, maybe soon Florida broker. So we'll see. His leadership roles include serving as the founder of Capital Gains Tax Solutions podcast, founder of Capital Gains Tax Solution, and founder of Commercial Realty Apartment Advisors. Brett has been featured in various notable podcasts across the web and is a guest speaker every year who trains hundreds of business professionals. Brett also holds a Series 22 and 63 license and has sold over $85 million in commercial real estate. Brett, the floor is yours.
Hey, thanks, Ray, for having me, and excited to be here. And I'm going to see what happens when I share the sound here, see if we can kick it off with the video. But tell me if you can hear this, Ray. If you can't, we can just kick it off. Can you hear it or no?
Yes, I can hear. It's kind of low. If you want to bump it all the way.
Yes, absolutely.
Try that.
So the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys. that at least, from an investment perspective, that, it made sense to sell in a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. That's a little video intro there. Hopefully everyone liked that. My name is Brett Swarts. I want to welcome you to tonight's presentation, as Ray has already kind of teed me up for. I'm excited to be here. Quickly, it's not North Carolina, it's Northern California. So, but I am a huge fan of Duke basketball. So if you are from North Carolina and you are a Duke fan, then we are in good company, because I played basketball in college and that was our team of choice. And we rooted for growing up in high school. We kind of followed a lot of what they did for our team. Anyway, so if you're like basketball, then we're in good company. If you like the Tar Heels, I'm not mad at the Tar Heels, but I love Duke. So we're going to talk about how to defer 100% of your capital gains taxes, not using a 1031 exchange. Essentially, when you exit highly appreciated assets, if you're looking for some more freedom, if you're looking for some more flexibility, if you're looking for ways to preserve your wealth and create it, then this presentation is for you. As a legal disclaimer, I am not a tax attorney nor CPA, although I believe I worked with one of the best, if not one of the smartest persons I've ever met in the country. He's a tax attorney and CPA. He's the creator of the Deferred Sales Trust. And this message is only for educational purposes, and how and is intended to provide an overview of how the Deferred Sales Trust works and how it can be implemented. But we would strongly encourage each of you to seek individual independent legal tax professional advice. We work with CPAs all the time to make it a real win-win for everybody. And so quick is my background: father, husband, CEO, author, and podcast host. This is my wife and 5 children, 4 daughters and a baby boy. And we are now here in St. Augustine, Florida. A little update. I've closed about $500 million in commercial real estate transactions and DST transactions combined. I'm also still a broker myself. And I'm one of the few who have actually closed 1031 exchanges, Delaware statutory 1031s, and also deferred sales trust. And I grew up actually in Northern California, Bay Area, Sacramento area. And we just got out to St. Augustine about 11 weeks ago, and we're loving it here in Florida. So let's keep going. What do? Well, we help individuals sell and defer capital gains tax and eliminate estate tax on the exit of assets of any kind, so they can preserve their wealth, and then they can create more wealth and unlock freedom. It's kind of a big statement there, but I'll break that down as we go along in the presentation here. Most of our clients are looking not only for capital gains tax deferral, they're actually looking for freedom. And in fact, if you're in the multifamily investment world or passive real estate world, you're looking for perhaps financial freedom or some passive cash flow to give you some time and some energy freedom to perhaps replace your day job and or supplement your retirement. Well, guess what? My clients are looking for the same thing. And not only that, but they're looking to get into these type of investments with someone like Reyes, where they can have an extra, 25 to 50% of their gain be invested. If you like investing in multifamily syndications or other commercialized syndications, why not have an extra 30 to 50% of an exit of an asset to be able to roll into that? And that's the really amazing thing about the deferred sales trust. It's any asset of any kind. What does that mean? Well, it could be a stocks, bonds, it could be public or private stock. It could be cryptocurrency. It could be a primary home. It could be a business. Now, how many of you knew or didn't know that none of those apply or actually qualify for a 1031? In fact, none of those do. In fact, the only ones that do are investment real estate properties, right? And so if you're in the chat, maybe let me know if you own anything beyond just a investment property. If you own some highly appreciated public stock like Apple stock, or cryptocurrency like Ethereum or Bitcoin, or even like a primary home that has multiple $1 million of gain, guess what? The 1031 does not work for you, but here's the good news, or a business that you're selling, the deferred sales trust does. And so it's any asset of any kind. Here's the key. It needs to have $1 million gain and $1 million net proceed. So it's got to be big enough. So you go, well, Brett, I don't have an LP position for 50 or 100,000. Does it work? No, I'm sorry, it doesn't. Brett, I have an LP position of 750,000, another one for 250. Can I combine the two? Yes, you can. Okay, so we like to see two assets of $1 million net proceeds, $1 million gain is the minimum, or just one single transaction with $1 million net proceeds, $1 million gain. So what are we going to do? We're going to defer up to 100% in capital gains tax. We're going to eliminate 100% of the estate tax if you're ultra high net worth. And guess what? Never use a 1031 ever again if you don't want to. Now, if you do, that's cool. We still help people do 1031 exchanges. If so, Ray knows some people or he does it himself. That's great, but sometimes it doesn't fit for everybody. And then we're going to unlock this capital to invest. We mainly like real estate, but some of our clients want to diversify into some securities or business ventures, keep some liquidity, pay off some debt, and keep some capital for a rainy day, and or capital on the sidelines to buy when deals make sense. We also coach top-tier real estate, CPA, financial professionals, and other high-net clients who struggle with capital gains tax and estate tax challenges. Let's talk a little bit about our purpose and why we're here. We believe we have a calling to fight the good fight of freedom. And part of that freedom has to do with the total net worth of America and where that's going in the next 20 years. It's known as the silver tsunami. How many of you know the amount of wealth that's going to transfer in the next 20 years? If you could put it in the chat, how many trillions of dollars do you think from the baby boomers to the millennials? What is the guess? And if you guess correctly, I will give you a copy of my free new book, Building a Capital Gains Tax Exit Plan, at least whoever's closest. All right. So just put it in the chat. We have a new book coming out here actually in 3 days. But if you guess correctly, I'm going to give you a free copy. In the Q&A. So how many trillions is it, Ray? What do you think? Is it greater or less than $25 trillion? What do you think? It's greater or less than, Ray? What do you think?
I think it's greater.
Okay. Do you think it's greater or less than 35 trillion?
I think it's between 35 and 50 if I get a guess here.
Okay. Do you think it's greater than 65 trillion? Because it's greater than 50 for sure.
Oh, wow. No, then you beat me on that one. Anybody else have any guesses here? Make sure the chat is working.
And I'll keep going. We got some people there. But basically what's going to happen is there's a lot of trillions of dollars that's going to transfer, okay? And these trillions of dollars are tied to high-end primary homes, businesses, and commercial real estate. In fact, those three asset classes represent 50% of the total net worth in America. And if this capital goes to the government, that no matter what side you probably vote for, you probably would agree that they're not very great stewards with the money. They tend to waste a lot of it. And they actually tend to take more freedoms away from especially real estate investors or people who are building wealth. And that's the big challenge. Like, where is money best kept? In the hands of the people who created it, or in the hands of a government who might waste it away? And so that's kind of another conversation we can have. But the point is, if this amount of money, we're going to see what the chats say here in a second, goes to the government instead of in the hands of the people, it's going to, I think, it's going to create less freedom for us, right? Versus being in the hands, so it can be unlocked to be invested in families and communities. So we see ourselves as an impact company, and our purpose here is to help people envision a future that they truly want: freedom of time, energy, business, primary home, location freedom, passive, cash flow freedom. But also, you can be active. You can be an active entrepreneur with the trust. And our big, hairy, audacious goal is to become a Fortune 1000 company through the achievement of our mission, which is basically positively impacting 1 million lives by providing about 100,000 capital gains and estate tax solutions. And we're going to do this. This is the way we're going to do it, through our mission, which is leading and inspiring the building of wealth and freedom with our clients and partners through the relentless execution of these solutions. So let's see what we got here. All right, we got 8 people. We got one person that says we got 80 trillion. We got 100 trillion. We got a lot, 85 test. Excellent. The answer is estimated $84 trillion. This is according to the best ever real estate conference in Utah. If anyone was there, I was there. I think Ray was there. I think Ray was there. Maybe, maybe not. This happened about a month ago. And John Chang from Marcus & Millichap gave one of the opening speeches. And he said, this is one of the biggest things that most people maybe not be aware of, but 84 trillion. Can you think about that? The government debt right now is about 32 trillion, right? So more than double the amount of our U.S. debt is going to transfer from the baby boomers to the millennials, and then by 2045. Okay, so this is part of our flywheel. We're super focused on that transfer, and as that transfer of that capital gains tax and the estate tax is what's at cost right now. And so the key is to invest these funds into not only defer the tax or eliminate the estate tax, but then to invest the funds into real estate. We believe this can help solve the housing crisis. Ray, how many multifamily buildings could you build if you had $1 trillion right now?
Oh my goodness. I'd have to get the spreadsheet out on that one, but quite a few.
Yep. You can build a lot of units, probably there in Orlando, in North Carolina, in Alabama, in Tennessee, in Texas. Maybe you could even afford to build in California. What do you think?
Yeah, I may be able to buy a single family home in California with
The point is, these trillions of dollars can be used to infuse into communities, all capital gains tax deferred, partnering with multifamily syndicators and operators and developers to solve what? The housing crisis, right? The housing crisis. And that's an amazing thing. There's 4 million units that were down right now. I don't know how many trillions it would take to build those 4 million, but 84 might do the trick, right? And that's what we're up against. But if it's taxed, or if people don't even sell it, don't even move it because they feel trapped by this capital gains tax and estate tax, then guess what? The funds are not invested into real estate businesses and securities, which do not create more jobs and more housing, which do not create more wealth and freedom. So that is our flywheel, okay? And how we're going to get this done is we're going to live and breathe and execute on our core values every single day. I'll just share one of these with you. Anyone read the book Rhinoceros Success? If you did, put it in the chat. If you haven't, please pick up that book. It's such an amazing, it's a fun read. It's hilarious. It's really inspiring. And it's basically about a rhinoceros who's charging through a jungle and is determined to stay focused and stay charging forward to reach massive goals. And so that's part of what we try to practice. And also try to be great stewards with our clients' wealth, and as well with the wealth that and opportunities that we have to serve more people. So here's some client success stories. This is David Sloan, and David exited 5 multifamily syndications. He was the GP on all of these, and over 120 million across multiple states, multiple exits. And he used the deferred sales trust. He liked it so much, he's bringing in some LPs now. He told his whole story on YouTube. You can hear his story, but you can imagine someone who's an attorney, who's a multifamily syndicator. He is very skeptical and cautious when it came to anything besides starting in 10 and ending in 31. But he used the deferred sales trust. Here's another client of mine, Dave Levinson. Anyone out there in Athens, Georgia? Ray, I didn't even know there was an Athens, Georgia. I thought Athens was just over in Europe, right? But there's an Athens, Georgia. I didn't even know that until I met Dave. Dave has bought and sold hundreds of properties, and he used the deferred sales trust for the first time to save a failed 1031. And his quote was this: the DST was created for times like this. Times like what, Ray? When there's change, when debt is adjusting, when inflation is happening, when deals aren't making as much sense for you, the 1031, when you want to maybe be more retired and more passive, when you're looking for different freedoms. And so the DST provided him these freedoms without having to pay massive amount of tax on the sale of a $7.6 million multifamily property. This is Dharma. And Dharma closed some short term. What Dharma does is he buys land. Well, he ties land up. He doesn't actually close on it right away. Then he'll develop it for 6 months, and then he'll find a buyer, and then he'll do like an assignment of sale. But what that creates is what's called a short-term capital gains tax, which is not eligible for 1031. But guess what the deferred sales trust is? It's eligible for short-term or long-term. So we did 37 million of exit in 2022 alone. Dharma is super not only smart, but also cautious when it comes to anything that doesn't start with the 10 or end with a 31. This is Stormy Atkins. Her and her husband, she's a nurse at Mayo Clinic, sold an Airbnb property. And I think her best quote was, "Don't be afraid of it. Learn, educate yourself." And it's, it's coming from her. She's like an emergency nurse. And so she's faced with a lot of challenging situations in her line of work. But then she says, then, it's trust, ultimately the team, but understanding how well it had worked out for so many others before me really helped me, and just really helped being engaged in the process and moving forward. So that was Stormy. Here's a client of ours. He just closed a $17 million business sale in Sacramento, California. And it's a media company, like a billboard company. And so his name is Jeff. He'll be sharing his story here soon on our YouTube channel. And that unlocked freedom for him to travel more and move out of California. He's one of those that are relocating to like the Floridas or the Tennessees or the Texases, right? Some of the Carolinas. And he's excited to kind of start a new chapter in his life after building his massive business. Here's a client named Shay Pope. He moved out of Alabama, and then he built multifamily housing. In fact, the Deferred Sales Trust funded his next business venture. So if you're saying, well, Brett, I don't want to be just a passive investor. Perfect. You want to be an entrepreneur? Excellent. This is exactly what Shay wanted to be. And that's what he did with the trust. He's able to defer his tax on a business sale. And guess what? Partnered with the trust to invest into multifamily housing. Not just existing, he actually helped build the project, all tax deferred. Pretty cool. All right. This is Ron Anderson. He and his wife just wanted more freedom for him and his wife to have more time to enjoy life. They had this massive amount of cash flow from this Airbnb property, but it was just taking up a lot of their time and their energy. And so he used it to help his exit. Here's another client of mine. We call him Skeptical Steve. He grew up in the multifamily Napa Valley winery area. Parents owned about $30 million of assets, and they would talk about 10 and 31 about every night. His parents were also real estate professionals. And guess what? He was able to use the Deferred Sales Trust for the first time to save a failed 1031 and also end a partnership that he was in. And the list goes on and on and on. Sacramento, San Diego, Saratoga, Texas, Cupertino, Monterey, New York, New Jersey, across the country, Bitcoin, Ethereum, business sales, mostly multifamily deals, primary homes. We also wrote a book. The book is called Building a Capital Gains Tax Exit Plan. And it's the proven playbook for unlocking your ideal wealth plan. And just for everybody, guess what? I will give everyone this book for free on the Kindle version. But you've got to log into Amazon on April the 20th. And because you're with Ray and you're listening to this, and if you're listening to the replay, you can get there on April 20th for 24 hours. This will be completely free for the Kindle version. Now, this is 300+ page book. We have amazing authors, like Tyler McBroom, who's Tony Robbins' CPA. You might recognize a few of those other gentlemen, but we also have Kevin Harrington from Shark Tank in the book. But just go to Amazon and look up Building a Capital Gains Tax Exit Plan on the 20th, which is just Thursday, just a couple days, and you can download the free Kindle version. All right, so how does the DST work? I'm glad you asked, okay? And how do we eliminate this 1031 altogether? Ray, are you ready to participate?
Ready to rock and roll.
All right. So Ray, let's imagine you have a $10 million apartment complex that you've owned for 27 and a half years. You have fully depreciated this asset to zero. Let's keep it simple. Let's imagine you have zero debt. Let's imagine it's actually in Taxifornia, which is around 40% is just a good number to use. And so you're looking at a $4 million tax liability. Are you seeing that, Ray? Okay. Yes. So this is what happens. We find a cash buyer for 10 million. They're all really excited to buy your property. And let's imagine they gave you this $10 million tomorrow, Ray. How much of this 4 million would be triggered if you took 10 million in cash right away? 4 million. You see that?
The entire amount. Yeah. The
entire amount, right? So we don't want that to happen, right? We're just going to erase that line. What we're going to do is we're going to ask this buyer to cooperate with this third-party trust, okay? Now, this trust is going to be set up, and it's going to come in right in between close of escrow. So step one, you're going to sell it for 10 million to the trust. The trust is going to sell it for 10 million to the ultimate buyer. So if it bought and sold for the exact same price, what's the trust gain on this, Ray?
It's all deferred.
Well, if it bought and sold for the same price, if the trust bought it for 10 million, sold it for 10 million, what's the gain?
Oh, 10 million, yeah.
It's zero, right? He bought and sold for the same price.
Oh, gotcha. Yeah.
Yeah, the trust, right? Yeah, yeah, that you got it. So then the 10 million is going to be put into the trust here. Okay. This is what's going to happen. The 10 is going to come here, and you're going to receive a promissory note. So instead of saying 10 million in cash, you're going to get a promissory note. You're going to become the lender. So if you got a 0 down payment tomorrow, Ray, and you carried back 100% financing for the trust, how much tax is owed on 0 if you receive 0 tomorrow?
Yeah, 0.
You got it. So this other 4 million is deferred. Do you see how it's deferred? Because you haven't received any of the 10 million. So there's an extra $4 million plus the 6 that you would have had. It's a total of 10 that's in the trust. Remember, it's sitting here. But there's a promissory note for 10. So you became the lender. So you traded your ownership hat for a lender hat. You seeing that?
Yep.
I'm going to pause here, Ray. Is there any questions you have about what just happened?
No, it's an intermediary. I guess the difference is that, if it's a 1031, it's one type of intermediary. If this is a different one in the sense that it's not just a holder, it's actually then allows you to then lend that money. So you're getting the benefit of that loan, whereas a 1031 is just a holding mechanism more than anything else.
You nailed it. It's kind of like a 1031. It's kind of like an IRA. It's kind of like a 401k in that you're delaying the actual proceeds in exchange for, in this scenario, a promissory note that you are making interest on versus the QI making the interest. Now, what are these structured at? Typically 6 to 8%, depending on your risk tolerance, net of recurring fees. Okay. So on 10 million, let's say I was at 8%, looking at about $800,000 of cash flow. Now we got to go make the money. That's what the promissory note says, right? So we've got to go invest the money. But Ray, what kind of returns are you typically doing over a 3 to 5 year period?
Yeah, we're doing about an 8 cash on cash and about a 15 AAR.
There you go, right? So this is the part where it gets really fun, right? Because I'm just going to clear out some of these drawings here. But remember what happened is you had a $10 million promissory note. Okay. And let's say it's at 8%. And guess what? Most of our commercial real estate investors like to do it. Did you know it? We like to partner with groups that have proven track records in multifamily, typically housing, B or better properties. This could be, whatever they like. It could be a mix between A, B, or C, but value add, mobile home parks, all of those different things that are producing a predictable return. Because guess what? We got to go try to make this money. All right. We got to invest it. It's not going to come out of thin air. So one of the investments can be into, let's say, a deal with Ray, multifamily, right, Ray?
Yes.
Yeah. Now you might do a little bit of mobile home parks to diversify a little bit. You might do some industrial, right? You might do ground up multifamily. You might do. We do need to keep about 20% in liquid funds. By the way, you might even do some lending. You might even lend to multifamily operators, right? Lending, working with a group that pays about 10% right now, get the money out in about 30 days. 20% we like to stay liquid, okay? Okay, it's like a reserve, and we typically, this would be stocks, bonds, mutual funds. We're not big stock market people, but there's definitely some diversification advantages here. Okay, you can hedge and protect, but this might be a sample allocation. Okay, now if you're just 100% passive, you can have the funds just sent back to the trust on these investments. Let's imagine this is making on average 10% across the board, right? Let's say it's making about all 10 million went into this allocation. It's making about $1 million of cash flow that flows back into the trust, that it pays some fees, and it pays you about $800,000. There's probably still some left over too at that point. Do you see how we're going to make that money, Ray?
Absolutely. I guess my question is on here is it's interest bearing regardless of whether you use that then to invest in other assets, or it's only the percent of what stays in the trust, I guess.
Yeah, so this is all in the trust. It's just invested in different things, right? And so this promissory note is always going to be accruing every year, right? The question is, how much is it paying you out? Now, you can take all 800,000 of cash flow, but you might only take 4% of cash flow, or 400,000, right? And you're going to let the other $400,000 accrue and build up and compound. Right? You may only take 200,000
earnings in, because your investments are paying you back, but then you're also getting that return on the note.
Yes, you got it.
Wow. Okay.
Yeah. Well, yeah. The investments first are paying back the trust, right? Or I mean, the trust itself is earning interest, right? Let's say it's all. I'm going to go to active here in a second, but it's all passive, and it's just accruing, and it might be paying you out 4% or 2% or 6% or 8%. I mean, you decide what you want the payout. Not everyone needs the full 800,000 to start, right? But whatever the difference is, it's compounding and building up. It's just like if you own a house and you have a loan on it, you might accelerate the payment in 15 years, or you might do a 30-year, right? You might do interest only, you might do interest and principal, you might do partial interest. It's customized about how it can pay you back, which is a nice thing. Okay. So now what if we want to be active, right? What if you're like, I want to be an entrepreneur, I want to partner with the trust? Perfect, right? There's 10 million here. We like to say about 80% can go into a joint venture partnership with you, JV LLC, or the trust puts up 8 million, let's say in this scenario. The other 2 million's in liquid investments, okay, staying diversified. But you, Ray, let's say this is your LLC, you are 80% owner. The trust is 20. Ray, you put up $0. The trust puts up all the money. It's a silent joint venture partner. So you remember how we would have paid this 4 million up here? Well, guess what? Let's just act like this 4 million is right here. The government's charging you with 0 interest. Are you married or single, Ray?
I'm married.
All right. So yeah, you have the full $10 million deferral. If you're single, it's 5 million, although we have another strategy that works for excess bigger deals. But do you see how I'm basically using the government's money that's charging you 0%? You just put it you just put for that 8 million into this JV deal, which let's say you invest into your apartment complex that does a 14% IRR over 3 or 5 years. And this 8 million grows to what? It doubles in 5 years. That's like 16 million. How cool is this, Ray? Guess what happens? This original 8 gets paid back to the trust, which owes you the money anyways. Now there's an extra 8 million. Now the trust will also ask for an 8% pref. Okay. So you got to pay the pref return. Let's just say that's another, I don't know, it's called $1 million, right? Now there's an extra 7 million left over. How does that 7 million go, Ray, if you have 80% ownership of that upside?
What is that, about 5 million, isn't it? A little over 5.
Sounds about right. Let's see here. On 7 million, 80%, it's $5.6 million. So, Ray, do you see how this $5.6 million, 4 of it was the government into this 8. Now, this is your sweat equity. You're working for this, no doubt, right? But you put no money yourself. The trust put up the 8 million. And there's another $5.6 million that's created in wealth. Isn't that pretty cool?
That is fantastic.
So what can you do with this? Well, this, you can actually, I'll go to the next page here in a second. You can actually put promissory note number 2. Okay. So now you have a note for 10 million. Now you have the second one for 5.6, a total of 15.6 million, all at 8%. And on this sale, depending on what state it was in, let's just say we deferred another, let's just call it 30%, right? Because it's not, maybe you went to Texas instead of California. So you deferred about $1.68 million of tax. You seeing that?
Mm-hmm.
I know that's a lot there, but that's the point of this. We're going to create and preserve more wealth by using the government's money that you would have paid a tax. Now, they like this because they're getting tax revenue. You're still paying taxes as you would take payments. And if you dip into this principle, you're going to pay cap gains tax. But most of our clients will just live off the interest payments. They will not dip into the golden goose that lays the golden egg. And they'll just maybe take 6 to 8%, and they'll always keep a little cushion between the original 8% interest rate. And they'll just pay ordinary income tax on this 6 to 8. All right. So now you're saying, well, I'm thoroughly confused. You could be, you might be, but that's okay. Because guess what the next page shows? Entire breakdown of this. Okay. So you ready, Ray?
Yeah.
All right. We're going to try to keep it really simple. Okay. Let's imagine the deal is a little bit smaller this time, but essentially your promissory note is $1.25 million. Okay. And we structured it at 8%, which is $100,000 a year. So you're just the lender to the trust. It's $100,000 a year of 8%. Okay. Now this interest can be paid or deferred for a short period of time. In other words, you could just say, look, I don't want any payments for like 2 years. I'm already a high income tax earner. I'm moving out of New York. I'm moving to Florida next year. I want to start payments once I have established residency in Florida for a lower income tax. Can you do that? And the answer is yes. You might say I have a big earnout, or I'm selling a business and I need to stay on for a couple of years. Can I delay for a couple of years? The answer is yes. Now the other 8% is just accruing. It's just building up. So that's just a little nugget there. Now you say, look, I want to partner with the trust. So you form a new LLC. Okay. The trust is split 80-20, 80% to you, Ray, the managing member of that LLC, the majority owner. Trust puts up 100% of the capital. Well, in this scenario, say he puts up $1 million and asks for an 8% preferred return. This new LLC invests into a passive real estate deal. Now, it can be active or passive. It could be with yourself or with others, no problem. And let's just say it's averaging 10% per year. Okay, the $100,000. Now, on an 8% pref, guess what? $1 million at 8% is 80,000, right? So what happens? That 80,000 distribution goes back to the DST that owes you the money anyways. Because remember, it already owes you 100,000 per year, right? Remember that, Ray?
Mm-hmm.
This is where we're going there. And the 20,000 leftover is what? Split 80-20 per the LLC partnership agreement, which is 16,000 to you. You're the note holder or the managing member of the LLC, and 4,000 to the DST. Now the 16,000 goes to the LLC, goes to the note holder. Now you likely might do some cost seg, which guess what, Ray? It's probably going to wipe this 16K out, right?
Yeah.
Okay. And the 80,000 goes back to from the LLC to the DST to pay you back on promissory note number 1, but you might be delaying that payment for a year or two. You see that, Ray? So potentially you pay no tax. You receive $16,000 from the LLC. You could delay this other 80, but it's accruing and it's building. So do you see how this deferred sales trust can be an investment and not an expense?
Absolutely.
All right. So questions. We're going to open it up.
So we've got one question from Kevin. I'm going to answer that one live. I'm assuming it says, how do investors then get paid at the end of the hold period? I got to think he's talking about syndications, right? If it's an LP that uses this to invest. In other words, a DST then is invest in a passive syndication.
Yep. Yeah. So the answer is it all depends on what the returns were, right? And if they were in excess of the note, if you just were a passive investor. Now, if you did the joint venture LLC, you would get the excess on the upside, right? So this 1 million that went in, depending on the pref return over, let's say, a 5-year period, if it went to 2 million, you'd pay the pref of 80,000 per year. Anything left over would be split 80-20. So it's per the partnership agreement. So you get additional upside, which is pretty awesome. Hopefully that answers the question for you.
Kevin, is that clear the question? And now you can jump in, man.
Yeah, I was just trying to find out, like from the LP's perspective, if at the end of the deal, they would get paid if this is how it's structured?
Yeah, the answer is yes. It's actually probably the same way you would get paid with Ray if you're investing in one of Ray's deals, right? There's probably some kind of pref return that he's offering to the LPs, and then probably some kind of split 80-20 or 70-30 or something, right? Depending on the deal. And so the trust itself is investing with you into an LLC, of which you can invest into as an LP into other deals. And it would just all flow per the partnership agreements. It's just one extra layer with the trust. And the reason you do it, obviously, because you may have an extra 30 to 50% in there because you exit it. So yeah, we'd have to map it out, and depends on each deal, but just per the ownership structure.
Okay, so then just to be very clear, the LPs and the DST will be two investors in the same deal. That's what you're saying?
Pause. So the DST would invest into an LLC.
Yeah.
And they would be a partner in that LLC. And that one LLC you could invest into as an LP into one deal or two deals or five deals, whatever, right? So the entity itself that's investing is the LLC. The LLC is broken up to partners. It's kind of like a fund-to-fund model, right? Have you ever done a fund-to-fund model?
Yeah.
Where everyone's investing into a fund and that fund invests into another fund or another deal? It's just kind of like forming your own little fund-to-fund here. It's just the fund is the DST. And the second fund is like Ray's deal.
Okay, got it. Thanks.
That's a great analogy. That helps. Got another question from Vince. Vince asks, what is the downside of a DST?
Yeah, what are some reasons we wouldn't use the DST, right? Number one, the downside would be your deal's too small, so you don't have enough tax paying to offset the expense, and the expense is about 1.5% to 2%. So it's got to be a win-win for the numbers, right? So if I put $1 million in tomorrow, basically it's going to cost me about $15,000 one-time setup fee if my asset sales price was $1 million, and it's going to cost me about $15,000 to $20,000. It's going to cost the trust, that is, which is a mix between your money and the government's money. And so this is why we want to have $1 million net proceeds and $1 million gain to make the numbers work, right? As long as you have those two things, the numbers work. As long as you don't need to spend all your money tomorrow on your primary home or your cars or your boats, right? You can defer it and you don't mind investing it. Then the numbers work, right? So if your deal is too small, then the fees are too expensive. But if your deal is big enough, then the fees are just an investment, not an expense. So that's number one. The other downside would be everything involves risk, right? It's not a guarantee. Like there's nothing about this promissory note that's like personally guaranteed by the trust is a single entity trust. It only does business with you. It's never commingled. It's never, you have to approve of all the investments, but there's still investment risk with these investments. By the way, track record is thousands of closes, billions and billions and billions closed, over 24 no change IRS audits, 27-year track record, lifetime audit defense. It's literally batting 1,000 and it's perfect. It always works as long as you work with a team that knows what they're doing and executes all the little nuances that are involved here. So the downside could be, oh, my CP hasn't heard about it, so I just rather pay the tax, which sometimes happens because people get fearful because they've never heard of it before or their CPA doesn't know about it. So the investments could go south. But guess what? Even if the investments go to zero, not that Ray's going to go to zero, but if it did, or any other deals, you don't owe the tax on what you haven't received. So there's no real downside there. Yeah, it's a third party unrelated trustee. So some people are like, that's my company. You have to get comfortable with me and what we do and the team that we work with, but we never commingle the funds. We use third-party financial advisors, third-party CPA firms to do the auditing and to the tax return, third-party commercial real estate operators like Ray to invest with. That's where most of our money goes. So to me, it's really like, where did the money end up? Is it in Ray's multifamily deal or my own deal or, a mixture between? That to me is the most important part. We're just like the wrapper being like an IRA or a 401k, right? We're the wrapper that keeps it in this tax-deferred state. But yeah, those would be the main things there. Hopefully that answers the question for you.
Right. Can you have more than one GP to get to this 1 million, or does it really have to be individual?
Yeah, it has to be individual. And so it could be a married couple or a single person. So we just did a deal in San Diego, $13 million exit, and it was 4 clients. One just paid his tax. The other 3 did their own DST. They're all married, they all were individual family unit, one married couple or one single person. So that's part of the, I guess you could say, downside. But yeah, these things they take a high level of execution and skill, right? And so that's just the way it is. Yeah, we cannot do a group model. It's one individual family.
Got it. The questions?
So as a trustee, is there a period of time for the money to go ahead? Someone else want to say something?
Yeah, I used the wrong word, but for some reason, anyway, I was the one that asked that question about me. If I'm opening a trust, if I'm keeping the money there, is there a limit in time to keep it there?
That's the beauty, that you can do everything at optimal timing. There's no longer a 45-day, 180 sprint, shotgun wedding, overpaying for a property, not being able to negotiate with the client, with the seller. You can buy whenever you want. You can sell high and buy low. You can dollar cost average into the stock market. It's really nice. You can pay off debt right now. You don't have to replace debt. That's why the 1031 is Blockbuster and the deferred sales trust, we believe, is Netflix, for that exact reason. There's no timing restrictions. You can literally just sit in the bank and just wait. Now, we don't recommend that because we can be making 10, 11% on hard money lending to multifamily operators that have proven track records. Or Ray might have some ideas too, right? Or even T-bills that are paying 4 to 5%. But there's nothing that states that you have to invest in a short period of time. You do have to have some business purpose and some investment purpose. So you do need to get the money working for you. But it's not like there's no set timeline on that.
All right. And the next thing is, so I'm assuming that in order to get a deferred sales trust, that will be basically through some of the financial businesses that got CFAs or CFPs, just like any financial advisor or planner, and go through one of those. And I guess they'll appoint a trustee to manage the funds for the client or the trustor, right?
Yeah, we use a third-party financial advisor. It's part of the transparency and accountability for everything that's going on, to invest into stocks, bonds, mutual funds for a percentage of the funds, sometimes all of the funds, depending on the client's risk tolerance and their preferences and their timing for buying real estate deals. And then we work with third-party operators like Ray to invest in their multifamily assets. It's really up to the client, though. I mean, what do you want, right? What do you feel comfortable with? We're just here to accommodate that. As a trustee, I do have to approve. I guess you could say that's a downside too. You don't have unilateral control. We have to do dual approval, because if you had unilateral control, you would own the trust. It'd be taxable. So, but we just work with you, your team, advisors. Everyone is a team to keep this thing working.
Okay.
Good questions. Good questions. By the way, I just dropped in the chat for everybody. If you're interested, if you drop your email, I will give you an opportunity to get a free gift of my Kindle version of my new book, releasing on April the 20th for 24 hours. You just got to drop your email there, and I'll send you instructions on how to do that. And then you can share that with anyone you'd like to, because we're trying to really spread the word on this, but it's only for 24 hours. Okay. So you gotta do it the same day on the 20th, everyone, for 24 hours. So you can just drop your email in the chat if you're interested in that. Does anyone else have any other questions? Or Ray, any other thoughts or questions?
No, I think I need to read up a little bit more on the whole thing, and then really just plan ahead. Actually, I do have one more. So say you had a transaction that went through, and you didn't know about this. And now you're thinking about it, but you've already taken, I guess the distributions come to you. Can you still execute this, or does this have to go directly to the
great question. Yeah, let's talk about timing of all of this. Okay, so that's super important. Yeah, you need to set this up prior to the close of escrow. In fact, if you also want a backup plan for a failed 1031 exchange, we can save that 1031. The key is you've got to get with us so that we can work with an exchange accommodator who's our strategic alliance, one of the top in the country, to give you the option for the deferred sales trust. So I'll say that again. In other words, I highly recommend that you never do a 1031 exchange with an accommodator who doesn't know what they're doing, nor will give you the option to use the deferred sales trust because they don't know what it is or they don't want you to know what it is. In fact, most commercial real estate brokers and most accommodators don't want you to know about this because they want to keep you in the 1031 exchange, race, right? Because that's how they get paid. So, and by the way, I'm a broker. I do 1031. So there's nothing wrong with them if you can find a deal that makes sense. We just don't want you to overpay. So your first option is, if you're in a 1031, is to work with us with an accommodator that will accommodate. If you contact me, I will connect you with them. And please, the worst calls I have is people who do not take this action right now to get with me to provide that backup plan. And they call me once they're with their accommodator, especially these really big box ones that are the big corporate runs across the country. And they hold them in jail. And I have millions of dollars in the accommodator, and they won't work. They want to work with me, but they won't, the group that they're working with won't accommodate. So never work with those who don't know what they're doing, because you will get stuck in jail, and it's the worst. Okay. So number two, everything else that's not 1031 eligible, you need to set this up prior to the close of escrow. But more than that, you need to set it up prior to the buyer removing all contingencies, which the best way to do it is actually to set it up before you even go into escrow. Because guess what? If you get into escrow with a buyer and the buyer won't cooperate with you, or they feel like they've given you a deal by cooperating with the DST, now they're going to feel like they're owed something. So you're probably saying, well, Brett, that sounds great, but I don't know for sure I'm going to do it if my deal is going to close. That's where we have you covered. We don't charge anything unless and if you do the deal. So we will literally set it up, consult with your CPA, your tax professional, your financial advisors, Ray, everybody. We'll talk with everybody. We'll set it up, get it all in there. If the deal doesn't close, you don't owe us anything. If you decide not to use the DST, you don't owe us anything. So we take all the pressure off, but you've got to pre-plan this. This is not something you can just throw in last second and expect the IRS not to say, you just threw this in last second and you owe the tax, right? You're going to owe the tax if you don't do it properly. Okay. Is that making some sense, Ray?
Yeah, absolutely.
So I just sent an email to everybody. It's on the 20th. You're going to get a calendar invite. It's actually 0 minutes. It's at 11 a.m. Eastern. It's going to pop up. When that does, you're going to log onto your Amazon account. You're going to search Building a Capital Gains Tax Exit Plan. That is the name of the book. Okay. And then you're going to click the free Kindle version to download. I want to put these instructions also in the chat here in case you don't get the email, but you should get an email from me. But those are the instructions just on the 20th. Log in your Amazon, click on the free Kindle version, and boom, you're going to get the book. Okay.
How did we set this up for the book, huh? That was just perfect timing for us.
You honestly made it out really well, because after the 20th, it's over. There's no other free version. So Ray, everyone give Ray a high five if you like the book. If not, then don't give him any high fives. Say you wasted my time.
This is going to be good learning for me as well. There's just a lot there, but I think it's just the way people learn, right? Some people need to read, some people need to see it. So this allows them to watch this webinar, which will be, it's being recorded. Thanks, Brett, for reminding me on that one.
Yeah.
We'll post that on YouTube. You've got the book, and if we'll even have the slides available to those of you that participated. So between all that, hopefully it'll capture most people and really allow us to get away from having to, and that was my thing with the 1031 is you almost feel forced to pay into a deal which may not be the best deal just because you're pressed by time. And this just kind of takes that away. So you can really have full leverage when you're negotiating. I love it.
Well, Ray, it's been more than a pleasure. I want to thank everyone for attending. If I could be of any service to anyone, please go to capitalgainstaxsolutions.com. And remember, you're just one deferred sales trust away from the freedom you may be desiring when you exit. So make sure you subscribe to the YouTube channel, Capital Gains Tax Solutions. And you can also subscribe to the podcast, Capital Gains Tax Solutions Podcast, on iTunes or Spotify. And then, of course, make sure you get the book, Building a Capital Gains Tax Exit Plan. Ray, thanks for having me.
Thanks, Brett. And to everyone out there, invest where it makes sense. Take care.